Hello and welcome to another Impact Insights. I'm delighted to have with me today Gareth Lewis, who is Commercial Director for MT Finance. Hi, Gareth.
Good morning. Good to see you again.
And you,
even if it is remotely.
Absolutely. Story of our lives at the moment, isn't it? I think it's going to be like this for a while yet. So just tell us, Gareth, what do you do at MT Finance?
So I'm Commercial Director. What that truly means is I do a little bit of everything. So I run an element of the strategy of how the business looks to grow. I'm involved in transactions on a daily basis, whether that be front end or on the back end when it comes to some of the challenges we face within the underwriting side of things, and obviously look after the sales side as well. So a little bit of everything. I just don't clean.
It's all hands on at the moment, isn't it?
Yeah, exactly.
I mean, it's been, it's well over a year since we last had a proper conversation, done an interview in sites like this. What's changed at MT? How have you changed the processes? What sort of trends have you seen over the last 12 months?
One of the biggest differences is our foray into the regulated arena. So we launched a regulated bridging product at the back end of last year, so final couple of months of last year. So that's probably the biggest and noticeable change that we've had within the business. It's something that's obviously been in the offing for a little bit of time. We actually put our application in September 2019, October 2019, and then had our full permissions come through in March last year. Obviously, when those full permissions came through, we decided not to do anything with them straight away because we're in a very different world, as you know. Most people working from lockdown. So to jump into a new area, a new arena, we took our time to digest what we wanted to try and do and where the market was going. We as a business, though, over this last 12 months outside of that, have obviously continued to cement our relationships within the broker community. During 2020, which was a tough year for everybody, we didn't stop lending. The flexibility and the depth of our funding models and the diversity of our funding models meant that we actually jumped in where other lenders unfortunately let some brokers down. So we jumped in and helped on transactions at the beginning of the pandemic and the beginning of the lockdown. Yes, we obviously evaluated where we were going on a criteria perspective, but we didn't pull one deal. We just found a way of trying to do them in some way, shape or form, mitigating any risks that we had to be able to do that as well. So that was a really good thing for us, and I think it was a good thing for the broker market to show that true support through what was a unknown quantity for everybody. None of us have ever lived through a pandemic, so it was something that was high on our radar when we first went into lockdown, to make sure that we could be there for you as brokers and partners, to make sure that there was some stability.
Yeah, that's great, and it's a really good accolade that you did that all the way through the lockdown period. We needed lenders like that, without a doubt, to see us through, because the housing market, from our point of view, was a key part, and glad it stayed open for the majority of the time. So did you actually review all your offerings? Obviously you went into the regulated side, but did you review what else you had? Did you review LTVs?
Yeah, look, we had to. I think anybody who didn't review was probably at a hiding to nothing, or just stopped lending. The reality is you had to mitigate risk. No one knew where the pandemic was going to take us when it came to property transactions, when it came to value, where are the risk points. With bridging being a short-term product as well, you've only got a sort of 12 to 24 month window where you're looking at a transaction's life cycle with you as a lender. So you have to look at, okay, what's the natural exit for a transaction in 12 months time? Where are we going to be in 12 months time or 24 months time? So we did trimmed our loan to values to 65% at the beginning of the lockdown. And we obviously looked at some of the risk points, the riskier deals, whether that be a commercial transaction, whether that be a heavier refurb where consumables were being heavily impacted from that side of things. So we were just aware of where the problems could come. So we did that early on. But that being said, every 3 months we were looking at the landscape. We were looking at where we saw the world going from a economy point of view, where we saw the government trying to lead us through stimulation. So we always kept an eye on what was going on, so that we could be fluid with our transactions and fluid with our criteria around it. because of that diversity to our funding structures as well. It allowed us to have that fluidity to turn around one day and say, okay, we're going to be at 65 on this, but we'll take an objective view on all transactions coming across. We've since gone back up to 70% on our standard residential proposition. So we're actually back at a position now in terms of loan to value as we were before COVID hit us. And actually we're offering a better proposition. It's actually a cheaper proposition than it was you know, at the beginning of 2020.
Okay.
So actually we've got better products than we've ever had available.
Yeah, sure. Have you seen a lot more? We've seen a lot more brokers come towards the bridging side. Having, you know, the specialist sector is very, very, you know, in demand at the moment across the board. The high street lenders are sort of taking their own business sort of back in house. So you've seen lenders migrate over to the specialist side and especially into bridging.
I think it's a natural progression for a lot of brokers. Look, Dale, you and I have been around this market for quite some time, and we know that it's enticing to brokers because they see it as an opportunity. One, they see it as an opportunity to retain business, retain a client, because it's the first time you turn around to any client and say, I don't offer that, they'll go to somebody else who does.
Sure.
So that client retention is a big thing, especially in today's environment. But also that the enticement is that it's something new, it's something shiny. Some of the remunerations are more than you would get from placing a high street mortgage. So there's an enticement that comes with that. So naturally, we're seeing more and more brokers come to the specialist arena. I would be always mindful of new brokers entering the market unless they can put their full impetus into understanding the market. It can be that it can cause problems. Sure. You could have a misinformed broker placing a deal with a certain lender just because that was the lender they knew or saw or emailed them that day or phoned them that day. But actually it might not be the best for that client because of the type of transaction it is, because of the, you know, the demand on that deal. Yeah. So you have to be mindful when you're a new broker of entering into a market where you don't truly have a full grip of the understanding of what products are available. No, we see that quite a lot.
Yeah, I think we see that as well in our industry. What sort of interest are you seeing at the moment? Are you seeing a lot of sort of chain breaks, finance info? Are you seeing a lot of refurbs? What's your main stay at the moment?
You know what? Naturally, there is a drive and demand for the chain break scenarios. That was obviously a stimulation off of stamp duty holiday that was put in place. So there was a big spike. I say big spike. There was a spike. It wasn't as huge as it had been in previous years in 16 and 09, definitely. But there was a stimulus towards trying to get those transactions over the line. We're seeing a lot of people now starting to look at business funding. So raising capital to put into their business to restart their businesses. Obviously, there's been a lot of businesses over the last 12 months that have been mothballed, whether that be in the hospitality arena or anything along those lines where the market for them hasn't been there. You know, I know quite a lot of people in the hospitality arena who have just turned around and shelved their plans and their aspirations for their business, mothballed it and waiting now for the stimulus to come out of the easing of restrictions as we go into sort of June and July and August. So there are those people out there who are now looking at the opportunity to raise some money, to inject some capital into their business, to look at stock acquisitions, whether that be from a furniture point of view, for an exhibition provider, or you know, other areas from that side of things. So we're seeing a nice flow of that type of business. We're still seeing refurbs, renovations, adding value to properties, looking at the stimulus of adding value to property, because that's a key thing for a property investor. You know, bridging finances, in my opinion, is twofold. It's an emotional purchase transaction. So it's that regulated arena, which is an emotional attachment to a deal where you're looking at downsizing, retiring to your favorite coastal location or closer to family. So that's the chain break scenario over there. And then you've got an investment, a business investment, where it makes you money, which is then the property investor looking to add value to transactions, whether that be light refurb, converting properties into HMOs, extensions to properties. Yep. You know, and when we're seeing this relaxation of the PD rules from commercial into residential, which there needs to be, because there are some businesses in the commercial world that are not going to come back and not going to go into those offices or not going to go into those shops again. There has to be that stimulus for what might well be a lot of properties that are left there vacant for a period of time. So again, that's an opportunity that we're seeing at this moment in time where people are looking to add value.
Yeah, we're seeing that very much in demand on the investor side currently, especially when buying dilapidated properties, wanting to refurbish them, bring them back up to scratch and so on, and also office blocks, like you said, is a huge demand at the moment. Valuers, where are you with regards to valuers at the moment? Are they doing their job as best as they can in the current climate? Are they understanding the bridging side? Are you seeing down valuations? What's the scenario at MT?
Valuations is always an interesting topic of conversation. There's a big squeeze on valuers at this moment in time from a PI perspective, which means that there are valuers that are moving away from the bridging arena because the PI insurers are deeming there to be a higher risk on this side of the world.
Yeah.
I'm not really sure why. Ultimately, it is a property transaction that actually the shelf life of the lending is shorter. So in theory, provided the loan's been done in the right way, there isn't as much material risk on the value as you would expect over a longer period of time. That's a different subject. I think value of properties as a whole, there was a big push at the back end of last year where we saw a spike in value, where we saw the pent-up demand for people to transact in property was seeing property prices go up. But I think it was a false spike. What you've seen, I don't know whether you'd agree, but what you've seen at the beginning of this year is you've seen prices now soften. So there's this interpretation that clients and customers can always be their own worst enemy. They see something go next door at a slightly higher value and deem their property to be worth more than it actually is at that moment in time. But the reality is that's a stimulus because somebody wanted that property at that moment in time, and there was this unnatural bubble of increased value. Now what you're seeing is over these last sort of 2-3 months is you've been a softening and a realignment of value, which means you are seeing a few down valuations coming into there because the natural line in the valuations is coming down. But a deal's still there to be done. Just because a value changes from day one till the underwriting process, there is still a deal there to be done, and there is still opportunity to be had out there from that perspective.
Yeah. The property price is what someone values it at themselves, what they're happy to pay for that entity. We've seen it around here where houses are not even making it onto the websites and going for 10, 20 grand over the asking price.
Yeah.
In which case then a valuer comes out and says, well, actually it's not worth that. But if you're going to pay the extra 20 grand yourself, then obviously that's down to your individual circumstances.
And I think a good value is worth their weight in gold. What you've got at this moment in time is obviously properties being registered on land registry is taking a little bit more time, which means the data on value is taking a little bit more time to come through. So a valuer should be really delving into the local market, speaking to the agents, finding out where property prices have actually turned around and sat over the last couple of months to see where the realistic demand is in that area and where the realistic uplift in value is in that area. Unfortunately, if you've got a valuer who's just going around and ticking the boxes and not putting the thought into what's happening in that locality at that moment in time, they're just working it off of Rightmove or land registry figures. That's an easy way. It's an easy cop out on evaluation to a certain degree.
Yeah. Okay. And we had this conversation offline. We're all working silly hours. We're doing, probably 10 times the amount of work to earn the same pound that we were 12 plus months ago. Is this sustainable? Brokers are going through this at the moment. Is this sustainable? And are we going to see, once the stamp duty ends again in the end of June, are we going to see a decrease in working applications coming in, for example? Are we going to have a little cliff edge, do you think, or is it going to carry on now for the rest of the year? Because it is busy.
Look, it is very busy. I think naturally what you'll see, I think there's an element here where clients are taking their time to digest, excuse me, what's going on. So they're quick to press the button to say, I want to move on with this, and then they're slow to gain you all the information, which means that pulling the information together to package a deal for a lender becomes a little bit more harder. So you're working harder to establish all that information that would have been readily available, very, very quickly in the past. I think lenders working from home, which a lot of them are, where it becomes disjointed. So the underwriting process of a transaction then becomes disjointed. There'll be more piecemeal information being passed to you from an underwriter of a transaction as well, which means your life's harder because you're having to turn around and really work hard on each transaction. I think the market as a whole, it's really interesting because a lot of the market sentiment will come out of where unemployment sits once we do truly get out of the back end of this pandemic and the lockdowns, because there are still a lot of people that sat on furlough. There are still a lot of businesses, as we alluded to earlier, that are mothballed still at this moment in time. So until we truly know where that's going to end and where the unemployment figures truly sit, there is always going to be this this notion of hesitance coming into a longer period of time. So as I say, I think you will have a slight lull after and at the back end of the year, where people just reevaluate where they are, reevaluate what they want to do, how they want to do it. So I think there'll be a softening element to it, but it's a crystal ball. I wish I could say.
And we talked about valuers, so let's talk about solicitors. A lot of people like to use the family solicitor who's looked after all their finances over the years and everything else. They're not the right people to do bridging, are they?
No, not at all. An experienced solicitor is worth its weight in gold. The reality is, and I've said this for quite some time, the bridging world isn't complicated, but it's faster paced. There is an element to it that there's a requisitions list that comes through. And the age-old sentiment I've always said is, a solicitor who doesn't know bridging, who doesn't know the pitfalls around, or not pitfalls, the speed and the urgency around the transaction, will ultimately get their requisitions letter. They'll look at it and go, right, I'll deal with that tomorrow. Yeah. Whereas if they looked through those requisitions, they could quite quickly turn around and say, well, like, there's 30 points on this requisitions list. 15 of them I can deal with now. 5 I don't need to deal with. And there's another 5 I need to go and ask some further questions on. And they can quickly label them out, pull them in together, deal with them, get some of them over to the solicitor to get them moving. The problem you have is when a family solicitor or an inexperienced solicitor will turn around and go, well, that's not needed, that's not needed, that's not needed. Why do I need to? And then they'll challenge everything. Yeah, before you know it, you're a week down the line and they've done nothing with what's going on. So to have a good solicitor acting on both sides of the transaction is really imperative. And that's where the support of people like yourselves come into play as well, by turning around and trying to help a client through the transaction and saying, look, this is your option. You can do, this is the client's solicitor, this is the client's, how they're going to act on this. I've got a list of all these solicitors who transact in this arena, who you can utilize. Choose from there. You're not pushing them to use one specific firm, you're giving them an option, but these are experienced people that they can help smooth the transaction over the line.
Yeah, absolutely. And we're all in this to get that transaction completed. That's the most important part.
Definitely.
You've got a slick marketing team and you've got a slick brand. What about the technology side? What are you doing with the technology at the moment?
Heavily investing. Technology is an interesting one. I think technology in terms of information gathering, how you pull together a transaction, how you pull together the documentation you need to support the transaction is a real boost. We were in a very privileged position that when the pandemic hit and we went into lockdown, we had systems in place, whether it be telephone systems, whether it be our online portals for CRM systems. They were all there readily available. So as soon as Boris turned around and said on the 16th of March, I think it was last year, London needs to lock down, everybody worked from home the next day. So we had invested in systems and the infrastructure around systems to really try and work on that. What we're doing now is continuation of that. So how do we harvest data? How do we harvest land registry data? How do we harvest AVMs to support an underwrite to give you that stimulus to look at a transaction? So we're pulling all of this information together to allow the smoothest transaction possible in terms of information gathering. Technology will never take over what is the scratch and sniff test, which is the experience, the understanding of a transaction, because you can put in any kind of algorithms that point towards what you think you should do on a transaction, but there's nothing like saying, well, I've seen that before, I've dealt with this type of transaction before, this is the pitfall you're going to have to understand, this doesn't feel right, there's something not quite there that doesn't make me feel comfortable to do the transaction, or I need more information. You will certainly need human touch in the specialist arena. And I think anybody who turns around and says technology is going to take over the bridging space completely, I wouldn't want to see their loan book at the end of that journey.
Absolutely. And then just coming up to the end of our time, why should a broker use MT Finance?
Look, I'm biased. MT Finance is probably one of the best lenders in the marketplace for really taking a true understanding of what bridging finance is all about. One of the main reasons we wanted to move into the regulated arena is because I felt that the regulated space, especially, had fallen foul of forgetting what bridging is all about. It's that flexibility, it's that commerciality, it's that getting things done simply, efficiently, and quickly. That's what we do. You know, it's our DNA. It's built within us. We look at a transaction. We look to come back to you within an hour to say this is what we can do on the deal. We look to problem solve all the way through. We look to be commercial with how we look at a transaction at the front end as well. So if there's a deal where there's a helping hand that needs, whether that be a loan to value push or whether that be a pricing push, we'll look at it objectively at the front end, as well as listening to the feedback from brokers. So look, slick, efficient, understanding, commerciality, they're the real key things that the bridging finance needs. You know, no consumer wakes up in the morning and goes, I need a bridging finance loan. They have a transactional need. And I think we have to remember that in this space, that it is a transactional need that we need to adopt and help a broker, you know, place and work on. So we're good at that.
Awesome.
Good at doing bridging.
Good at doing bridging through impact, obviously.
Yeah, of course.
That is a brilliant end to our conversation. Gareth, really appreciate your time. Thank you very much.
No, thanks again.
And thank you for watching. Watch out for more of these soon. In the meantime, stay safe and keep well.